Good day everyone, thank you for joining me. I'm Tamara Kukshinovich and I'm going to take you through the SA Corp EIA. In March, SA Corp released year-end results. The highlights were as follows. Revenue decreased 9.7% to 2.1 billion rand and 6.9% on a like-for-like basis. The cost-to-income ratio grew from 40.2% to 48.7%. Net property income fell 20.3% to 1.1 billion rand and 16.7% on a like-for-like basis. Net finance costs increased 9.9% to 474.3 million rand. The interest cover ratio deteriorated from 2.6 times to 1.9 times because of the reduced net income. Overall vacancies increased from 4.6% to 14.9%, while the traditional portfolio vacancies improved from 4.2% to 3.5%. Distributable income decreased 37.4% to 601.1 million rand. The company declared a dividend per share of 17.93 cents at a 75% payout ratio, which was previously 100%. Total debt fell 4.1% to 6.7 billion rand. The property portfolio, excluding the Zambian properties, decreased 8% to 16 billion rand and 7.7% on a like-for-like basis. The loan-to-value ratio worsened from 36.6% to 38.6%. NAV per share fell 15.9% to 401 cents, and this was primarily driven by the fair value loss on property. The market's reaction was positive after the announcement, with the share price closing at 198 cents per share on the day. This represents an incline of 4.2% in the share price. Since the group released its interim results in September 2020, SA Corp outperformed the SAPI index with a return of 81.7%, while the index returned 26.4%. Year to date, the share price has also outperformed the SAPI index with a return of 13.3%, while the SAPI returned 5.1%. On a price-to-book basis, the group is currently trading at a 33.2% discount to its peers. It is also trading at a 40.9% discount to its 5-year average. The discount is justified given the moderately high gearing level as indicated by its loan-to-value ratio of 38.6%. However, it remains well below the covenant of 50%. Additionally, the group is trading at a 51% discount to its NAV, which we believe indicates that the share offers good value. The interest coverage ratio was impacted by the negative effects of the pandemic, considering the group's exposure to retail and commercial sectors, and has fallen to below the covenant of 2 times at 1.9 times. However, the group has been actively engaging with its lenders for the temporary relaxation of covenants at year-end. The group was in compliance with all lender covenants applicable. Additionally, SA Corp's interest cover ratio is above the peer average of 1.4 times. The near-term cash requirements are relatively moderate, with approximately 14% of term debt maturing in the next year. The group intends to use a large portion of divestment proceeds to settle debt. The lower market rental growth assumptions, weak macroeconomic environment, and the impact of COVID-19 resulted in assets being impaired by 8% to 16 billion rand, and this excludes the Zambian assets. The Zambian joint venture was impaired by 8.5%. At FY20, the board had decided to decrease the dividend payout from 100% to 75% to have financial flexibility and to preserve liquidity. Management also decided not to provide any guidance due to the high level of uncertainty. While we do recognize a difficult valuation cycle, we feel the share offers value trading at a 51% discount to its NAV. However, we are concerned with the group's position in terms of breaching covenants, so we maintain our neutral recommendation for a property-only portfolio mandate. If you'd like to place a trade, please speak to a financial advisor or contact the dealing desk. Additionally, the reports on SA Corp can be found on MyBase. Before we end off, please take note of the following disclaimer. Thank you.